SBCE system, Brazil's mandatory carbon pricing mechanism. Both companies noted the SBCE could increase operating costs and reduce competitiveness, yet neither disclosed a strategy to minimize those financial impacts. We see a parallel logic in China with the aluminum producer Chalco. A recent state development plan for the aluminum industry banned clean energy share by 2027. Chalco lacked specific disclosures on how they would align their production with these new, industry-altering state requirements. When sovereign states mandate regulatory shifts, a corporation's lack of an adaptation strategy is treated as a direct threat to its long-term market position. This accountability is enforced through a specific voting mechanism. BlackRock targets individuals in leadership rather than relying on abstract, non-binding shareholder proposals. On a corporate board, the oversight of material risks is delegated to specialized committees. At PBF Energy, management identified coastal refineries at risk from sea level rise, but provided no data on capital expenditures to protect those assets. BlackRock voted against the chair of the Health, Safety, and Environment Committee. At Hang Seng Bank, the firm voted against the chair of the Risk Committee because the bank failed to disclose financed emissions data provided by its regional peers. This method targets the re-election of the specific directors whose committees are chartered to monitor these unmanaged risks. While corporate boards often recommend the routine re-election of these chairs, institutional voters are using committee charters to identify blind spots in oversight. Targeting individual chairs places the accountability for climate and transition risk on the same directors responsible for traditional audit and legal oversight. The voting data shows this logic applied across all sectors. In Poland, JSW Group faced a dissent for failing to detail how its board received information on climate risks identified as material to its coking coal business. In the United States, AutoNation received a vote against a director for failing to disclose the board's oversight of risks associated with corporate political activities. These companies operate in different industries and face different external pressures, yet the criteria for a dissent remain the same. Institutional capital requires standardized transparency to price risk into financial models. The Q2 2025 voting results provide a framework for corporate leadership. Sustainability stewardship is an exercise in strict quantitative financial diligence. The requirement follows a three-step sequence: identify the material risk, disclose a quantifiable mitigation strategy, and empower a board committee. When a company fails to disclose the strategy or oversight mechanism, the consequence is a vote against the responsible director. Merely acknowledging a risk in an annual report is no longer sufficient. Under institutional scrutiny, a company's financial resilience is measured by its board-supervised roadmap.